Do you want to know how to identify Australian suburbs before they surge in value, potentially doubling your investments compared to the average investor? Would you like to replace guesswork with scientific precision when selecting your next property investment? In today's video, I'll show you how smart investors are using data-driven methods to time the property market with impressive accuracy, something that many experts say is impossible. By the end of this presentation, you'll understand exactly how to track the specific indicators that constantly predict price growth, how to identify suburbs' position in its market cycle, and how to implement a proven framework that has helped my clients achieve a 20 to 30% growth while others settle for single-digit returns. If you don't know who I am, my name is Wilson Yuan, and I helped hundreds of people purchase investment properties through my brokerage, Heroes Home Loans. And I've built my own property portfolio to a tidy 3.5 million in 5 years. Please click on the subscribe button right here if you're a serious property investor looking for the best strategies to retire early and retire rich. Now, let's tackle the biggest myth in real estate investing. You can't time the property market. This common belief says investors should just buy good properties, hold them for a long time without trying to buy at the perfect moment. Now, 30 years ago, that advice might make sense because Australian property investors didn't have much information. They mainly relied on agents and looking around neighborhoods. It was mostly guesswork. Today, we have powerful data tools that make choosing the right suburb a science rather than guessing. I'll show you the exact framework to use data to help you spot suburbs ready for growth. But before timing the market, we need to understand about market cycles. Australian property goes through clear cycles, times when prices rise up, peak, fall, and recover again. These cycles aren't random. They happen because of clear reasons like jobs, people moving, and how many homes are available. History shows that suburbs that haven't grown for 3 to 5 years after the past boom usually grow again when the economy improves. Knowing where a suburb is at in its cycle will help us time our investments. Second, what does timing the market really mean? Well, timing the market doesn't mean predicting the future exactly. Instead, it means using facts to make smarter choices. By using this following framework, finding suburb places in the market cycle, watching key signs that the prices will soon rise, and using a clear and organized method to check these signs. Now, this doesn't promise perfect results, but it can raise your chance of success from around 30% to 70 to 80%. Now, part 3 is using simple metrics to predict growth. Let me explain this clearly. The main metrics that we use to predict price growth are the following. Firstly, days on market, which means how many days does it take to sell a house after it's been listed. It matters because when the house sells faster, it shows that more buyers are interested, which usually means the prices will go up soon. If the days on market get shortened by 30% or more over a 6-month period, prices usually rise with the next year 78% of the time. Now, the second factor is auction clearance rates. This tells you how many houses sold successfully at auctions compared to all houses offered at auction. It's important because the higher rate means more buyers are competing, driving prices up. When auction clearance rates stay above 75% for over a 3-month period, prices usually rise within a year about 82% of the time. The third one is rental yields and vacancy rates. Rental yields show how much rent you can earn compared to the price of the property. Vacancy rates show how many rental houses are empty. When yields are above 4.5% and vacancy rates are below 2%, it means a lot of people want to rent there, making the suburb much more popular. Prices often rise within the 18-month period about 76% of the time. Now, the last point, infrastructure investment. This is money spent by the government to improve an area, like building a new road or school. When the government announces projects of over $100 million, it makes the suburbs more attractive to live in. Prices rise in about 71% of the cases within 2-year time frame. These metrics aren't guesses, they are proven by years of property data. Part 4 is bigger economic factors. The big picture, we get better results by adding bigger economic factors into the equation, such as interest rates. So when interest rates are low or going down, suburbs at the beginning of a growth cycle usually grow faster. Migration patterns. Migration means people are moving into an area. When more than 2.5% of people move into a suburb each year, prices usually go up faster, about 65% of the case. Now, employment growth. Employment growth means more jobs are being created. Suburbs with more than 3% job growth each year usually have prices growing nearly twice as fast as compared to areas with fewer jobs. Now, the ripple effect. This means when prices go up in one suburb, nearby suburbs usually grow soon after. This happens about 83% of the time. Investors can use this to pick suburbs next to areas that have already grown, knowing prices will likely rise soon. Now that I've given you all this information, How do you implement this step by step? Well, step 1, find suburbs that haven't grown much recently but looked ready to grow. Step 2, track important metrics such as day on market. Pick suburbs where the homes are selling faster. Also, look at auction clearance rates. Choose suburbs where rates are over 75% for several months. Rental yields and vacancy rates. So look for yields above 4.5% and vacancy rates under 2%. Infrastructure investment. Choose suburbs with upcoming government projects worth over $100 million. Price difference. Find suburbs next to more expensive areas with prices at least 20% lower. Now, the tools I like to use is CoreLogic, RP Data, DSR Data, SQM Research, PropTrack, and HTAG to collect data. So what I do next is I score the suburbs based on these metrics. Higher scores means better chance of growth. Now here are some examples of real success showing these methods work. So for example, Parramatta during 2014-2015, homes sold quicker, rents were high, and big projects started. Investors made 37% growth, much more than Sydney's average. Another example of this is Sunshine in Victoria. In 2017 and 2018, this suburb showed key signs. Investors made 28% growth, while Melbourne averaged only 9%. Or we can look at Chermside in Queensland. In 2019 and 2020, all signs were strong, and investors made 23% growth despite the challenges in the wider market. Now, these strategies aren't perfect. Big economic problems or government changes can sometimes affect the predictions, but overall, using data always helps you give better results than guessing. Now, in conclusion, using the data to time property market can really work. It uses facts and careful analysis, not guesswork. But knowing market cycles and watching important metrics, you can find the right suburbs before anyone else notices. Now, start using the method today. Track your metrics carefully, choose wisely, and invest with confidence. Thank you for watching. Follow this plan and you'll find the high growth suburbs early, potentially doubling your returns and getting closer to financial freedom.